Negative interest rates. Isn't the Eurozone becoming more and more fragile?
I think the Eurozone, excuse me, I think the Eurozone is incredibly fragile. And there are, the one thing that sort of strikes me about this is that for a long time, Mario Draghi has been, he's been sort of living on borrowed time in terms of sort of he will do whatever it takes to save the Eurozone. This is something he said some way back now. And yet his hands are effectively tied as to what he can do. And what everyone wants him to do, or what the markets seem to want him to do and the big institutions want him to do, is to come out with outright quantitative easing to be able to print money. I mean, for all the stuff that he's been doing at the moment, he's doing his asset-backed purchases, this, that, and the other. He's talking about buying corporate bonds. He's talking about this, that, and the other. This is all actually by the by and small beer, because what Europe really needs to do, in the minds of the Keynesians and now, and looking at what's happened elsewhere, is to be able to print money to try and sort of inflate things along, and to sort of, and the Germans, the view of the Germans is is still that they won't let him. And we've got this thing going on over there at the moment where I think it's the German Constitutional Court had a look at OMT, the outright monetary transactions, and they had a few issues with it. And they've bunged that back now to a European court, who are going to have a look at it. And they said, well, yes, we could allow it, but only with certain changes. But those changes are so significant that it would actually undermine the whole OMT, the whole business of OMT. So that's pending, that's out for next year. But in the meantime, we're seeing yields, creep up in those peripheral countries. Greece is back in, if not as main, not right at the sort of focus of in the windscreen at the moment. It's, the problems are building up again. So none of the problems are going away. They're all still there. They've all been sort of dampened down for a while, but nothing's been solved. So yes, Eurozone is fragile.
Negative interest rates. Not much about that. The ECB shot markets last week. Well, in September, with the rates cut. A cut in the referencing rate from 15 to 5, and a cut in the deposit rate from -0.1 to -0.2.
Okay, well, I mean, I think the the ECB going to negative interest rates. Again, okay, I from what I can remember, I think there was a market effect, because it was seen as additional. It was seen as stimulative, because it meant that there would be less money being lodged with the ECB and more money the banks would lend elsewhere, and it would trickle through somehow. But again, it's tinkering around at the edges, really, of the real problem. And the problem that everyone has at the moment is that there are real structural issues in the Eurozone, structural issues in the US and the UK, worldwide. And yet, everything, the only answer seems to be a monetary response. In other words, keep the cost of money low, penalise savers. This is a sort of, it's a suppression. If interest rates weren't under the control of central bankers, if the market could find its own sensible interest rate, so you have an offset between borrowers and savers, borrowers and lenders, if you like. What is the cost of money? What's the right cost of money? What am I prepared to accept as a risk premium for lending my money? What's the basis, and then what's the spread either side of that? That's what we should be dealing with. Not the central bank shouldn't be looking at that. And okay, the ECB might say, well, if you really insist on sticking money with us, then you're going to have to pay for it, because it's the ultimate. This is where it's safe, and whereas such and such a bank could earn, maybe 0.25% overnight by sticking it with some Landesbank or some Austrian bank or wherever, but they might not be. They might be a little bit wary that the bank might not be there the next day, and neither might their money be. But I still see it as tinkering around the edges, and it's a little thing, and ultimately, Not ultimately, but in the meantime, the ECB has got to try and somehow the ECB, Mario Draghi, has got to sort of get around the Germans to come up with quantitative easing. But again, really, the really difficult problems going forward over the next 5-10 years are structural ones, and monetary policy isn't going to solve it. That doesn't solve structural problems.
Mm. Is really a zero currency rate sustainable then?
A zero currency rate. Do you mean what? An interest rate at zero?
Yeah. Sorry, a zero interest rate. Well, there's a great in stabilising a shock in the market. The change from zero to normal is very difficult to do without causing a soaring currency or a plunging stock market. So, I mean, is it, how do we get out of it? Or is it impossible?
I think it's terribly difficult. At the moment we're sort of trying to second guess central banks and also listen to what central bankers are telling us about what would be their trigger for raising rates. We've got a fairly good idea that in the US, and bear in mind that Janet Yellen, in the US, sort of like the chairman of the central bank holds sway. Over in the Bank of England, you've got a vote of people. There's a vote on it, and the majority wins. Over in the US with the FOMC, it's different, and sort of the chairman holds a lot of sway, as does the Bill Dudley, who's president of the Federal Reserve Bank of New York. And they're very, very dovish, and they're at the top of the Federal Reserve. And next year, the FOMC, the Federal Open Market Committee, the actual committee who decides rates, is going to get even more dovish. So in other words, they're going to be erring on the side of keeping rates low for longer. And the trigger that they're looking for is a pickup in wage growth, and without that, they're not going to raise rates. And there's just no evidence that that is coming anytime soon. So, it looks like we're set for a low rate environment. Now, the trouble with low rates is that, once you're at zero bound, there's nowhere to go. What happens if we have another, what happens when we have another crisis? What are you going to do next? Well, you can't lower rates, so what are you going to do? Well, in the US case, it'll be more quantitative easing. So it'll be sort of increasing their balance sheet once again. And it's already gone from $500 billion just a few years ago to $4.5 trillion. And what do you do now? Do you double that? And then what do you do? I mean, and how do you unwind that? Can you ever unwind it? Well, we'll see, won't we? But it doesn't seem that we're in a situation where we can. Maybe this is the new normal.